your first role as investor was with Jeff.
Yeah.
Why do you think Jeff asked you to join his team as an investor, given that you're a journalist?
I don't think he wanted to. I mean, it wasn't the natural, and I'd never owned a share. Parents had never owned a share. I'd looked at the share market through the lens of a journalist for 4 years, and it was intriguing, so I was excited by it. But I'd never been an investor. I just didn't have the excess capital. You know, it was all about just survival when you're at uni, and then hand to mouth. You know, you're paying rent in Sydney and so on, and
buying train tickets out to your first job.
Yeah, and that first job, paid me $16,700 a year, and $1,300 went on the train ticket up front. So I mean, I've moved on from there, obviously, and was on an okay wage, but tended to work weekends. My wife had the shop, worked at a cinema. That was all fun. You had plenty of energy, but I'd never done anything. But Jeff wanted to write a book, and I got to know Jeff he was a stockbroker with Prudential Base, and I'd started to talk to him a lot in the last 18 months when I went to that investment editor role, and people noticed I was the investment editor, so people started to call me that didn't call me before. And I've met Jeff a couple of times, but then he started to call me a lot, and for various reasons about things they were working on. He's a great promoter. And that was good because we formed a relationship and got to know each other. And then he said, look, I'm leaving probation. I'm doing 3 things. I'm setting up a funds management business. I can't remember what the second one was, and I'm writing a book. He's going to go on a few boards, that's right, and writing a book. And he says, I've got no idea how to write a book, but if you'd like to help me on, and I've got the blueprint, which is Jeff's, I think Swagger, I can't remember his
Jack
first
Swagger?
name. Jack Swagger, yeah, which was Market Wizards. He said, we'll do it for Australia. And I said, yeah, every journalist wants to write a book. I'm a reformed journalist. I mean, I'm not a natural one, but I've got to that point. Yeah, I'll write a book with you. And about that time, I started to look for jobs in funds management. I thought journalism, what's the future? In the sense that, not because I could see the internet coming or anything, but I looked at people around me and thought, I've got a girlfriend turning into a wife and all those normal things, and we're going to have kids. How do you support yourself? Is there other things I'm interested in? So, which there was. I was interested in how the stock market worked. I was really interested in people, interviewing people, and this was coming from a different angle. And so I went for a few interviews, and I was lucky enough to get a couple of interviews because I knew people. Peter Morgan, who was at Perpetual at the time.
That would have been a tough interview.
Interviewed me. Yeah, well, no, it wasn't too bad. He was okay, but I didn't get the job. Yeah. I mean, I think he did it because I knew him. And then I said to Jeff, I got a job offer, one I didn't really want. And I said to Jeff, I've got a job offer from, X, Y, and Z. And he came back the next day and said, well, you can't write a book with someone else, with me, and then work for someone else. He said, the business can't afford you, but come and work for us. And that was it. To be honest, Jeff had a reasonable idea of what he was doing, but not 100%. He hadn't been a fund manager for 15 years, and I'd never done it. So we were green, and he started WAM Capital, but just a sense of self-belief in a nice kind of way that he could do it. And the next 3 years was just an enormous learning curve on how the world worked. I mean, the first year working with Jeff, I still saw companies through the lens of a story. Was this a good story? Geez, that would make the front page of the newspaper. And he said to me, you've got to stop thinking about things in stories. You've got to start thinking about, hey, can you make money out of this investment? It took a while.
Yeah. What was it that changed? Can you give me a sense of what was the mindset? Because I think a lot of people hear about stories in the press and they get told about a story, or even reading our website, they hear a story about a stock. What's the difference there between thinking about it as a story and making money out of it?
Yeah, I mean, stories are always fun, right? Especially if you don't have to write them and you're not liable for what you actually print. You can, so it's all that gossip and that, and so they're always fun. But it took a while, and the difference is you've got to look at it through the lens of what is a share price going to go up or down, and you've got a whole bunch of factors. There's the financials, there's the management, there's how the market thinks about it, what sector it's in. It just took a long time for me to get my mind. I enjoyed all that stuff, but it wasn't. It was almost like learning a new language. Do you think in your native language or the new language? And it just takes a while. Really lucky not only to have Jeff, who was incredibly confident and a lot of self-belief, which just flowed into the organisation, but also about a year after we started, David Paradise from Paradise, which is now, huge Australian funds management group, came and sat in the same office with us. And there's a couple of younger guys who worked with him, Alan Crozier, who's still around town, and David Smith, who now works up in Singapore. They joined him. And they were more my age, so I got to hang around them. So I got to hang around Jeff, and then they used to invite me to company meetings and so on. They didn't see us as competitors, we all got on. And probably over that 2 or 3 years was the real steep learning curve, We were young, we didn't really know what failure was about, we're getting inflows, Jeff was growing the business, David was growing his business. And we all kind of worked together in a nice kind of way, and we all performed really well over the next 2 or 3 years. And that kind of set the foundation for my learning curve, getting ready to, take on more senior roles.
Well, why don't we get into how you invest now?
Yeah.
So you started Centennial, probably 3 years ago now, is it?
Yeah, almost 3.5. Yeah.
So I was listening to a presentation that you gave on the fund, and the thing that struck me straight away was that you felt like you could achieve 13 to 15% is sort of the range of returns that you're looking for. That strikes me as a pretty punchy sort of number. How do you get there?
Well, and it might be totally unrealistic, and we tell this to investors, that we've got, is that if you go back to the Wilson days, the way we constructed our portfolio, the weightings, the amount of stocks, if our strike rate's right, in terms of, if we get 60% of our calls right, we'll be able to deliver something like that, and we always carry cash. So that's how it was formulated. So that, and if you keep to a certain size, obviously if you get big, that's probably, difficult to achieve. But it might also be unrealistic in the sense that those numbers were printed from, obviously had Jeff looking over them as well. So, that also makes a difference because you've got quality person, generating a lot of those returns. But from 98 to 2011, we were able to do gross before fees of about 18.5%. Okay. And it was just that portfolio construction, how we went about buying things and so on, that I extrapolated. So the 13 to 15 should be after fees and costs. And if we keep to a certain size, we're pretty well closed to new investors now. So we just thought 150 once, and then our money and a couple of early investors gets to about 170, and we think we can do that. Mm-hmm. It might be totally unrealistic in the sense that in those days interest rates were higher, economy growth rates were probably a bit higher. Now that comes with negatives, higher rates, inflation, but now rates are lower, returns maybe have to be lower. And the performance of the Australian share market since 2009, when we bottomed in March 2009 after the GFC, has been abysmal. Yep. In any historical sense, it's been bad against places like New Zealand and the US. It's even lagged behind European countries. I'm not sure why that is, but we've had a terrible 10 years post the GFC in historical terms. When you've had a massive clean out like that, normally you pick up. Now the property market, as we know, up until 12 months ago, was able to achieve returns that are normal in Australia. So I don't know quite what it is, but the share market has been just a monumental disappointment to all those playing it. There's all good years, but if you take it all together, it kind of returns
the market level
4.5% or something a year, 5%. Like the average through every cycle has been 7 and 8%. And normally when you come out of the bottom, you would expect maybe 10% but it hasn't worked that way. And maybe it's just structure of the share market. Maybe it's it's something to do with where we're at in the cycle, and we will get those returns again, but it's not this time. I don't know.
Mm. Do you invest? Is how you invest now? Is that largely how you learned to invest from Jeff? Is it effectively applying the same way?
Yeah, I mean, you've got your own strengths, right? So what's the natural inclination is not to be bogged down by, even though I said Maple Brown was a great value investor, he had the luxury of investing primarily in the top 100, and it was all about making 1 or 2% better than the index. While we're not index aware, we just start from scratch and we don't follow. So it's a bit of a different game, but he did say bring yourself to the game, and my natural inclination is to buy stocks that are what is perceived as really cheap. That's where you start. Now you've got to be a bit more flexible on that, but all the same things that Jeff formulated and I learned off him around You know, it's got to have a decent balance sheet if it's a small cap. You don't want to load it up with debt because small caps can go broke. You know, there's no privileged position in that end of the world. And, you know, we've all been in companies that have here one day, you know, never to be seen again. That will happen to you, so get ready for that. The management, you know, you've got to judge. That's the bit of the magic. How do you judge management? You interview them a lot, you read a lot of what they write, you see if they stick to what they're saying they're going to do, all those things, just like you judge your personal relationships, you know when people let you down or whatever. You want businesses that have got good cash flow, that you know, there's plenty of times where the cash never meets the profit over. I mean, you can have one half or whatever, but it doesn't work over a long period, so you kind of think, well, what's happening here? You've got to be careful of roll-ups, you know, in the sense that it's hard to see what's actually happening. And at the end of the day, you've got to work out what you're really doing. I'm not a believer in, and I don't think Jeff ever was either, as a share market investor, you're not the owner of the business. I don't know where people get that from. You know, we like to buy shares as if we're the owner. No, you're not the owner. You're the owner of your funds management business. Your job is to work out whether the share price is going to go up or down. You're not running the business. You're not allocating the capital within the business. You're not determining what the good long-term future is. You're looking at a point in time and saying, it's cheap, it's worth more, and the market will pay more for it in the future.
Yeah.
And that can be...
Quite a black and white view on it, isn't it?
Yeah, your job is not to determine how a business should be run. Your job is to say, you know, is this share price over whatever time frame you want to give it? It could be long term, I'm not saying that, but or it could be shorter term because things re-rate very quickly sometimes, whether that stock's going to go up or down and how you play that. So...
I was having a bit of a listen back to a podcast that you recorded with my colleague Patrick this time last year, and he asked you about risks. And the first thing that you started off saying was, well, why don't we talk about things that aren't risks? And you said, I think that politics and geopolitical events around those get overdone as far as negative impacts on the market, and it often presents a buying opportunity. Right now, there's quite a bit of weakness in the market, and it seems to be sort of pointing to, at least partially, to trade wars happening in China at the moment.
Yeah.
Do you think the downward impact that politics and geopolitics is having on markets in Australia, but also globally, is presenting a buying opportunity?
Well, it can do, yeah. And to elaborate on that, there's no doubt that politics can affect markets, and even more so can have massive effect on individual stocks around regulation or changes in whatever. Seen that many times. Overall markets, though, I think it is exaggerated. The politicisation of markets, and why do we get it so wrong so often about, you know, Trump coming in 2 years ago, the markets were selling off dramatically. As soon as he got in, bang, up they went, you know, and it was against all kind of logic and reason, and until it kind of unfolded that, you know, that he was going to give tax cuts, he was going to juice up the economy, he was going to spend like a crazy man, and it was all good for stocks and earnings and growth, and so they all bought that. So, you know, it's overdone in that sense. Like now we're going to go through this fear and loathing about Labor over the next, you know, whatever period is, to say to May or maybe November, they're talking about next year, but at some stage where you probably think Labor are going to win, and there's going to be a lot of negativity about it, and people are going to get very bearish about the political side. Now, it could work out that way, but the market's ready for it by that stage, or it mightn't be that bad. It might be, you know, there might be some positives, but it tends to get overplayed. Now, the tariffs is an interesting one at the moment. It's definitely slowing China down, but it's probably not permanent. There's probably going to be a deal done, and all it does, as you say, creates some kind of buying opportunity. Even the negatives of tariffs between the two of them might open some doors for Australian opportunities. I mean, like I was talking to, and they presented at a conference a week or so ago, Select Harvest, who are a big almond producer and exporter in Australia. The 80% of the world's almonds come out of California, and increasingly the demand for those almonds are being driven by the Chinese as they eat better foods and so on. And so all of a sudden there's a tariff on those almonds. So the Americans are priced out of the global market. The Chinese are desperate for other almonds, and sure, they're going to come to Australia because they think they can get a quality product here. So that'll be interesting how that plays out. But overall, it probably creates an opportunity. China slows, they got to get it sorted out. And you know, maybe sometime next year and whatever, there's a stimulus to get China back going. So, but I think, it's always doom and gloom that there's going to be this, it's going to be a disaster. I mean, look at the banks and the Royal Commission. Short term, it's a disaster. It's slowing growth and so on. But you probably think in the long term, next 10 years, the banks are fit again. They've pulled back their lending and the excesses, and they've got their balance sheets right, which is a good basis for any economy, especially Australia, where the four banks, have got so much market share. We saw it in the early 90s, but it was done differently. It wasn't done around regulations. It was done through a recession and high interest rates. So I think people get too scared or too optimistic about things that don't eventuate, but in the long run, everything the market looks after itself.
Yep. The flip side to that, so that was the risk on the politics that you said you didn't think was a risk.
Yeah.
The things that you did say were a risk, or the three things that you called out, you said, what did we talk about? We used to talk about valuations.
Yeah.
You talked about the speed of interest rate rises.
Yeah.
And then you said if volatility started to pick up, you'd start to get worried.
Yep.
So on valuations actually not too bad right now. They're not excessive, I wouldn't have thought, at the market level.
Yeah, there's pockets, especially in the small cap end, and we're seeing, if we merge the subjects together, we've seen 2 bouts of heightened volatility this calendar year, which wouldn't have been around then, after a very low period of volatility. I think that's telling you is that I'm not necessarily believing we're in for a bear market. We might be, I haven't ruled that out, but we're definitely in for a change of what's going to lead the markets. We've had a long period where high growth, mainly led by the techs in the US globally, because you've had this low, interest rate, low inflation environment. Where the hell can you get growth? Going back to what I said, is it realistic to get returns? Yeah. Where maybe now it's actually a slightly different scenario. I'm not saying there's a lot of inflation, but there could be a slowdown on the horizon over the next year. We've got the tariffs, we've got rising interest rates in the US, the sugar hit from the US tax cuts, depending on if Trump can keep, spending money and so on, probably comes off. And I think the world's looking at a slower world economy for a while. And so you probably want to get more defensive. So I think the volatility at this stage, and if you interview me in a month, I might change my mind, but at this stage it looks like the share markets taking the volatility and out the other side will come a much more defensive kind of portfolio structure for most people. And that might last for 9 to 12 months, which would be a bit of a change. I think that's what's happening. But volatility definitely tells you something's going on. Yep. So be aware of volatility. Interest rates rising too quick, definitely an issue. Because, but I think that risk to a degree, let's see if they can control it, but the risk around interest rates is probably not as great as it used to be, because the Federal Reserve now just tells you so much about what they're thinking.
It's all in the market.
Yeah, and if we do get the slowdown, I mean, if you look at some of the forecasts about US GDP, might have peaked in the second quarter of this year, 4.2 or 3, whatever it was, going to 3.5, then 3. I mean, people like Goldman Sachs or groups like Goldman Sachs have got it going to 1.9 in the fourth quarter of next year. It's a genuine slowdown. I mean, it's not a recession, but it's a slowdown. So maybe you don't get as many interest rate increases. That could be good for the market. Yeah. They could have adjusted around valuations and slow down. All of a sudden you think, well, rates are going to stay low, therefore valuations aren't too bad again. Off we go again.
And they've taken the opportunity to get rates up while the growth rate was strong.
Now that's a good scenario. Yep. A bad scenario is that they lift rates, growth goes on again for a bit longer, and then they've got to jack it up to really pull it down hard. And that's probably where you get a bear market, I think. Yep. So we'll see how that unfolds.
Talking specifically around Australian market, we were talking prior to the interview that there's been quite a sell-off in that part of the market, which is obviously, well, maybe not obviously to our viewers, but that's a part of the market that you like to go and find ideas in.
Yeah.
What have you learnt about what changed in the small cap? What got whacked? What survived? And what opportunities has it thrown up for you?
Yeah, it's interesting because grey hair. Lucky I haven't got too much grey hair, but I fit the age category of a grey hair person. You always think that you kind of seen it before. That small caps outperform, and you can sit around at lunch or the morning meeting and say, well, we all know they're not going to outperform forever because that's just the history tells us that. The moment you go through a correction, and we're talking about over September, October, the small ordinaries fell by 11%, so some stocks fell by 25%, you still feel terrible. Like it just, you're never ready for it because it happens really quickly, and you're normally long the market, and then all of a sudden, you can't be short because your game is investing. What have I learnt? We are seeing two things, I think, happening in the Australian market. And maybe a lot of it's already played out. You're getting the PE contraction of those high PE stocks, whether they be in techs, whether they be in financial platforms that we saw with the Netwealths and the hubs and that. And they're all still operating very well. There's no problems with the businesses. Whether it be in some global growth stories, China-facing stocks, the premiums are coming out of them fairly quickly and continue to do so. And that's probably a good thing. So stay away from them for the moment. It's not completely done. The other thing is that it seems like the Australian consumer is probably not as healthy as they were even 3 or 4 months ago. We'll see with the numbers, but we've seen a lot of retailers come out. We've seen car sales fall off an edge of a cliff. For 7 months now, housing slowed down. And even more just general day level kind of consumption products are probably now starting to feel the pinch a bit. And that to me comes around from the credit tightening from the banks out of the Royal Commission, which we talked about earlier. So you've got to get under that scenario, probably a bit more defensive if you can. Companies that have, even though they mightn't have a lot of growth, but they can maintain a certain level of earnings while things slow down. Now, it was interesting, I might have that wrong because the Reserve Bank came out yesterday.
And pretty rosy, weren't they?
Pretty rosy, yeah. And they say a lot more than me. I mean, there might be very good reasons, and it could still be all around this spend on infrastructure. CapEx, mining's okay again. But I think a lot of small cap companies are internally focused on Australia and depend on the consumer. So I don't know how much the share market will get out of it. My bet is you just got to be a bit defensive for a while. Look, if you turn around and there's some kind of change, that the banks start lending again because they've been through, or they will lend again at a higher rate. I mean, credit growth 2-3%. Before 2007 it was 13%, unsustainable. Maybe 4 or 5, 6% is right. Again, but that could be a year away. China turns around and says, look, we've slowed our economy down, the tariff. Some stage next year, big stimulus package like they did out of the GFC. That could get things going again. But for the moment, to me, it looks like all slowing down for most sectors, both external and internally. So, and I think that's the market getting the wobbles. Yeah. That was probably the first step in it. And the wobble back in February was probably a forerunner to that, where people were just a bit too long. They didn't know what was coming, but everyone had put the same bets on. Everyone was pouring into those ETFs. You couldn't have enough tech, and it took about 8 or 9 months where things started to play out. Well, maybe things are getting a bit slower. The next 12 months not as rosy as the last 12 months. Maybe EPS growth has reached a peak globally for the moment. Not disastrous, but time for a change.
So let's use that as a starting point, because I'm going to hit you for an idea.
Yeah.
Your process is you want to see a reasonable growth rate relative to the PE.
Yeah.
And you also like to see a catalyst for the stock to re-rate. So have you got an idea that fits that defensive sort of mindset that you've just outlined there, that would fall into the Centennial process?
Yeah, like a couple of ideas we've had recently in the small cap area. Revolve around a little bit about industries that are doing quite well regardless of the domestic economy. So, for example, one that people don't like to go near, and we could be sitting here in 12 months saying, why the hell do we, is Tassal. So Tassal's on its lowest kind of multiple for a long time, and there's good reasons for that. Their returns are down on what they've grown, but their returns on their investment are down. Their return on invested capital is lower. So it takes 3 years to get, from the investment of starting the fish to you harvest it and sell it. So they've grown quite a bit in terms of, but supply from now on is constrained. There's not many places in Australia you can grow salmon, and you take on extra risk every time you go to a new area. Yeah. If you go further offshore, then You've got aquacultural risk. Fish are very sensitive to their environment and growth rates and so on. And that's been something they've had to deal with over the years, this disease and, But, so let's get to the positive side. Demand for salmon in Australia growing at 10 or 11% a year. You've got a dollar that's weak, which means the threat of offshore fish coming in, and you had to freeze them, they're not as good. If there's a price shelter there because it's more and more expensive for both retail and wholesale to buy offshore. And for the moment, the tassel guys, and their production's really good at the moment, and any of their big fish they can export offshore. And there's big demand in Asia for quality salmon. They all love Australian products because there's one thing they know, it's clean, and they'll buy that. So I think it's a nice sweet spot for them at the moment. So salmon is a food, as we know, and so that's normally resilient to economies. It's a high growth area because we think it's healthy, it tastes quite good, and you've got a dollar helping it. So let's just hope the aquaculture risk is right, and so the returns will start to improve again because the investment was made. So I like that. Yep. So that's quite good. On the small end, there's a little company called Midway that we like, and they do wood chips, and they ship most of them up into Asia again. So the dollar's helping them. And the dynamic that's changed there has been that China was a net exporter of hard wood chips. So there's all different categories of wood chips around the world that go into different products. They've become a net importer. And so it's turned the dynamics around. So we used to send all our wood chips, hard wood chips that come out of Victoria, Tasmania, southern parts of WA, up into Japan. And they were really our only customer. And so a weak dollar was really good. You beat the South Africans and the Chileans and everyone else. But now they've had their own problems. And now China is about 80% of the acquisitions now. So there's prices going up. They've got demand for product. The thing's not that expensive. It's a cyclical business. The dollar rises, China slows down or whatever. You don't want to be in wood chips. Yeah. But for the moment, there's a nice sweet spot there, and I think they're running their own course, regardless of the economy. So there's a couple of ideas. Let's see how they work. Both reasonably priced for this time in the cycle, and the next 2 years for both those stocks, if they can execute, you should see earnings grow quite nicely.
Very good.
But whenever you ask me about one or two stocks, the strike rate's pretty low. That's why we build portfolios.
That's right. Disclaimer on that one. All right, so you've got to be bullish. Last question. Can you tell me a lesson that you learnt the hard way? A story where something went wrong and you picked up a lesson along the way that you still think made you a better investor, or something that you remember, that was a bit of a tough lesson to learn?
Yeah, and I'm a believer that you never learn from your mistakes. You keep just making them.
It's one of your behavioural biases that you make the same mistakes over again.
So you've got to try and put some external rigour around those mistakes. And so one of the things is a stop loss, right? As I said before, a strike rate of 60% correct calls is just correct in the sense that they go up if you're long and go down if you're short. Not if they outperform the market. I'm just talking about absolute returns, which we look at. If you're hitting 70% of your calls right, it's too high, you sell the fund because you'll mean revert. If you're only 50%, then you've got to have a good look at what you're doing wrong. It should be about the 60%. So how do you stop yourself getting wrong in a meaningful way? You put stop losses in. And we try and do 10%, but sometimes you don't get that. I mean, you get bad news from a company that you've missed and it's, opens 30% down from the next trade. So sometimes unrealistic, and sometimes you try and make sure your liquidity is okay, but sometimes liquidity dries up, takes a bit longer to get out. But that's just trying to work out that's just trying to put something around to stop you. Now, let's get to the mistake. The mistake is always thinking you're right and the market's wrong. There was a little company called Signature Brands that was a tiny little company, and all the red flags were there in the world. But I thought I had a fairly good grip on what they were trying to do and better than the market. And the reason that was that my wife had owned a few coffee shops, and I kind of knew the dynamics of a coffee shop, believe it or not, what sells and what the margin was, only because I'd worked in there. And they had their main business was juices, like a competitor to Boost, which we'd all know in Australia. And they did, I thought, well, this is a good business, blah, 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 but they were paying too much rent. Boost was wiping the floor with them. And I was doing silly things like going and buying 3 juices a day to try and help sale.
To help the share price.
You're delusional at this stage. And it's supposed to be a nationwide business. But it keeps happening. You get on a stock and you think, I think I'm right.
You extrapolate your own knowledge.
Yeah. Well, sometimes you don't knowledge, sometimes you're silly. You think you know something and you don't. There might be judgment on the management. You're saying, no, they're good guys and they'll get through. And invariably, you just get it wrong and you end up losing 40, 50% of your money instead of the 10 to 15 or whatever you can get out of it. And it's always those biases that you have that you've got to have conviction, but you've got to somehow just mix it with what the outside world's telling you. You can't be stubborn. You can be convicted, but you can't be stubborn. So I sometimes float into the stubborn area, and it's I just can't get out of it. And because all fund managers got egos, like everyone, but normally bigger than most, because they think that fund managers. The other thing that I learned from Jeff was fund managers like to be right. That's not a good position to start. Fund managers should say, I like to make a return, not I'm right. Because sometimes you'll make a better return if you go against the view that you're right. Like I was saying, if I sold that stock instead of holding onto it, our returns would have been better. Not sticking to the idea that I'm right and they're wrong.
Prove it wrong.
So you just got to get that balance, and I think that's the lesson I keep learning time and time again. And you go okay for 6 months because you stay away from it, then you find another stock where you...
Great. Well, Matthew, at a personal level, thank you for all of your involvement with Livewire and
thanks for having me.
Getting involved. And it's been great to sit down and talk a bit about how you invest today.
I've really enjoyed it. Thank you.